Hi guys, welcome to another video from Little Too Simple. Gold has been considered a great store of value since ancient times, but is it really so in today's world? In this video, we will analyze 6 arguments that are generally used to justify or promote gold ownership. We'll see whether these arguments actually hold any merit and try to understand if gold is truly a great store of value or not. The arguments discussed in this video are taken from the research paper titled The Golden Dilemma. You can find the link to this paper in the description below. But before we dive in, a quick disclaimer. This video is made entirely for educational and entertainment purposes and should not be considered financial advice of any kind. And if you like these kinds of videos, please hit the like button, subscribe to our channel, and share this video with your friends and family. Now, let's roll. One of the most widely held beliefs about gold is that it is an inflation hedge. Historically, gold has been a poor hedge of inflation in the short run, but a relatively good hedge in the long run. The real price of gold has maintained its purchasing power over long periods of time. However, gold's long-run average real return has been zero, because while gold holds its value against inflation, it doesn't necessarily generate additional returns. For example, the price of some goods, like bread, has remained constant in terms of gold for centuries. This means that while gold does act as a hedge against inflation in the long run, it offers no real positive return. Since the purpose of investment is not just to hedge inflation but to earn returns above inflation, gold might not be a great investment for most people. There are 2 main interpretations of this argument. Number 1. Gold is a foreign exchange hedge. In this view, gold is supposed to offset declines in one's home currency against another. For example, if the US dollar declines by 10% against the Japanese yen, the price of gold should rise by 10%, resulting in no net loss. But this logic has a problem. If the price of gold in a country is driven by its inflation rate, and exchange rates are driven by inflation differences between countries, then gold can only act as a reliable hedge if one of the countries always has zero inflation, which is unrealistic. Number 2. Gold is a domestic currency hedge. The second interpretation is that gold protects against one's own currency losing value domestically due to inflation or deflation. But this is essentially the same as the inflation hedge argument discussed earlier. Thus, gold does not necessarily serve as a reliable currency hedge. Another common belief is that gold is an attractive alternative when real interest rates are low. It is true that historically, gold prices were lower when real interest rates were high, like in the late 1990s. But it is difficult to prove a direct correlation. Gold prices can be correlated with many other trends, not just interest rates. For example, gold prices also show a strong correlation with time itself, or with other economic trends. This makes it hard to isolate interest rates as the main driver. Therefore, it is not certain that gold is truly an attractive alternative to low-return assets. Gold is a safe haven in times of stress. This argument ties back to the earlier points. 1. While gold does not hedge day-to-day inflation surprises, it does provide protection in cases of hyperinflation. 2. Gold may not be effective against normal currency fluctuations but can protect against extreme scenarios. 3. The negative correlation between gold prices and real interest rates might actually reflect fears of major macroeconomic crises. So yes, gold can act as a safe haven in times of stress. But here's the catch. Major negative events like hyperinflation happen only once in several decades. This again makes gold's usefulness limited. Some argue that gold is still money and that we live in a de facto gold standard. But realistically, this argument is just another version of the inflation hedge story. And since we already concluded that gold as an inflation hedge does not explain its high real prices, this gold as money argument also falls flat. Of all the arguments, this one seems the most persuasive in explaining gold's price variations. To explore this, we need to consider how much gold exists, who owns the gold, how demand trends have changed over time. The under-owned argument suggests that not enough people own gold, and as more people move toward gold ownership, its price will skyrocket. However, this argument is also somewhat ambiguous, because technically all the gold in the world is already owned by someone. Still, changes in ownership distribution and rising demand can influence gold prices more than the other arguments discussed. Based on these 6 arguments, we can conclude that gold may offer some benefits during long periods of time or under specific macroeconomic conditions. However, gold does not offer exceptional returns. It may protect purchasing power in extreme cases, but for the average investor, it does not outperform inflation consistently in the short to medium term. Thanks for watching. If you've made it this far, let us know your thoughts in the comments below. If you found this video interesting, please like, share, and subscribe to our channel for more such videos. Until next time, have a good one guys.